Let me tell you about the day I became a second-class citizen. It wasn't because of a crime. It wasn't because of a scandal. It was over $35, the price of a decent dinner out. That's all it took to slam doors in my face for nearly a decade. This isn't another dry lecture on FICO calculations. Forget what you think you know about responsible credit use. I'm going to take you inside the visceral, humiliating, and often invisible reality of what a bad credit profile truly feels like. It's not a number. It's a wall. A constant whispering voice of no that follows you into every store, every application, every dream of stability. Over the next 30, I'll walk you through my personal cataclysm, not just the missed payment, but the terrifying domino effect it caused. But more importantly, I'll show you the exact unorthodox path I forged to claw my way back. This is a story of systemic shock, personal failure, and a comeback strategy so specific they don't teach it in personal finance blogs. If you've ever felt the system is rigged, listen closely. My financial education, like that of most people I knew, was not an education at all. It was an accumulation of assumptions. I operated under a simple, seemingly irrefutable principle. If you worked hard, earned a decent income, and paid your bills, the system would recognize you as a responsible adult. Credit, in my mind, was a peripheral tool for major life events, a mortgage perhaps, or a car loan. For the daily mechanics of life, I believed cash and a steady paycheck were the bedrock of integrity. This was my first and most catastrophic misunderstanding. I enjoyed the trappings of what society deems success. My career was on a positive trajectory, delivering an income that comfortably exceeded my obligations. I rented a well-appointed apartment, drove a reliable car, and funded a lifestyle that was neither extravagant nor austere. When I did use credit, it was strategically. I held a few credit cards, the oldest one a relic from my college days, a silent piece of plastic I kept for its lengthy history but rarely employed. My primary card was used for business expenses and convenience, paid in full every month without fail. To any outside observer, and most critically to myself, I was financially sound. My sense of security was not arrogance. It was a logical conclusion drawn from a consistent record of meeting my obligations. This is where the silent trap was laid. The American financial system does not primarily reward you for your income, your work ethic, or even for ultimately paying what you owe. It operates on a parallel dimension of data, a shadow history compiled by 3 major bureaus. This system is mechanistic, context-blind, and perpetually forward-looking. It cares less about your narrative, the unexpected medical bill, the job loss, the simple human error, and more about the binary, reported facts. My fundamental error was conflating solvency with creditworthiness. I was solvent. I had more assets than liabilities. But creditworthiness, as defined by the algorithmic guardians of lending, is a fragile score based purely on a curated history of reported debt repayment. I was ignorant of the rules of a game I didn't even know I was playing. The stage was set by a tool of convenience, a shift to paperless billing. Several years prior, in a fit of modern efficiency, I had enrolled in automatic online statements for all my accounts. It was an environmentally conscious, clutter-reducing decision. The old, physical credit card, the one from my university years, was included in this digital migration. It lived in a sock drawer, its number memorized by no one, a backup to the backup. The primary email on that account was an old university address I seldom checked, but it was the one on file from a decade earlier. Life accelerated. I changed physical addresses twice, a process during which updating every single financial account is a task that inevitably falls through the cracks. I assumed critical alerts would find me. I assumed institutions were proactive partners in my financial health. This constellation of minor oversights, the dormant card, the outdated email, the assumed efficiency of automation, created a perfect vulnerability. The system was functioning exactly as designed, sending its digital dispatches into the void of an inactive inbox. My life, meanwhile, was filled with the tangible realities of work deadlines, family commitments, and personal ambitions. The silent digital world of credit reporting and the noisy physical world of my daily existence were on 2 entirely separate tracks, destined for a catastrophic collision. I was living in the illusion of stability, unaware that the foundation was already cracking, triggered not by a grand failure, but by a series of invisible administrative negligences. The trap was not sprung with a bang, but with the utter absence of a notification. The catalyst was benign. A recurring annual fee of approximately $35 posted to the long-dormant credit card account. In the grand scheme of my finances, the amount was a rounding error, less than the cost of a week's coffee. Yet, this small, automated transaction initiated a chain of events governed by rigid protocols, completely detached from my overall financial reality. For the first 30 days, the scenario was one of simple neglect. The billing statement, generated electronically, was dispatched to an email inbox I had not accessed in over a year. No paper notice arrived at my current residence. The creditor's system, having received no payment, imposed a late fee. This was the first domino. At this juncture, the situation was still a simple customer service issue, a missed payment due to outdated contact information. However, the resolution window for such simplicity is narrow within automated financial architectures. Months 2 and 3 represented the critical escalation. With the initial delinquency unresolved, the account status transitioned within the creditor's systems from current to delinquent. The periodic statements continued their journey into the digital void. More consequentially, the contractual terms of the cardholder agreement were triggered. The annual percentage rate, once a negligible figure, was universally increased to a punitive penalty rate, often exceeding 29%. Interest began compounding on the original fee and the accumulating late charges. Crucially, there was no human intervention, no urgent phone call, no letter sent via certified mail. The process was entirely algorithmic, a cold progression of flags and penalties. The account was likely automatically closed to future transactions by the end of this period, a risk mitigation step taken by the bank's systems that further cemented the negative status. The 4th month marked the point of no return for my credit history. The creditor, following standard internal protocols for unresponsive delinquent accounts, charged off the debt. To them, this was an accounting action, moving the asset from receivable to loss. To the credit reporting bureaus, it was a catastrophic data point. The code CO, or charged off, was transmitted and logged on my credit file. This designation is not a simple late payment. It is a declaration that the creditor has given up on collecting the debt as agreed. Its impact is severe and enduring. My first tangible awareness of this disaster was not from the creditor, but from a promotional credit monitoring alert I received for another account. The notification was blandly algorithmic. A significant derogatory item has been added to your credit report. The shock was physical, a cold, sinking feeling of disbelief. Reviewing the report, I saw the entry, the creditor's name, the modest original amount now ballooned with fees and interest, and the stark, indelible phrase, charged off. However, the true insidious nature of the modern credit system was revealed in the subsequent automated domino effect. This single charge-off became a contagion. Other financial institutions with which I had accounts routinely perform soft inquiries or employ algorithmic triggers to monitor customer risk. The sudden, severe drop in my credit score, a plunge of over 150 points from the excellent to the poor range, activated risk mitigation protocols across my entire financial profile. Within weeks, I received letters from my other credit card issuers. They were not offers for increased limits or better rates. They were notices of adverse action. Citing a review of my credit profile, they unilaterally and drastically reduced my credit limits. One card's limit was slashed from $15,000 to $500. This action, while presented as a prudent business decision, triggered a second devastating algorithmic punishment. A core component of the FICO score is credit utilization, the ratio of your outstanding balances to your total available credit. By eviscerating my available credit while my balances, on cards I used for regular expenses, remained constant, these issuers forced my utilization ratio to skyrocket from a healthy 5% to a catastrophic 80% overnight. This further crushed my score in a vicious, self-reinforcing cycle. The system, in its mechanistic logic, interpreted the charge-off as a signal of profound distress and proceeded to amputate my other financial limbs, thereby ensuring I would indeed look like a far greater risk. I was not just being punished for the initial error. I was being systematically cornered by a cascade of automated decisions, each one digging the hole deeper. The $35 fee had ceased to be the issue. The issue was now my entire perceived identity within the financial ecosystem. I had become, in the silent language of algorithms, a toxic asset. The profound consequence of a damaged credit profile is not its numerical value, but its function as a universal gatekeeper. It became a permanent, invisible barrier that materialized at the most inopportune and humiliating moments, transforming routine adult transactions into confrontations with a past error I could not escape. This was the period where the abstract concept of a bad credit score became the concrete experience of systemic exclusion. The first major shock was the denial of an apartment application. My wife and I had found a perfect home in a desirable neighborhood. Our combined income was more than sufficient, our references impeccable, and our rental history spotless. We submitted the application with a standard fee, confident in our prospects. The rejection came via a sterile email. The property management company's automated screening system had flagged my credit report. The charged-off account and the subsequent low score rendered me ineligible under their firm policy. No human reviewed the context. No one saw the steady income or the glowing landlord references. We were compelled to negotiate from a position of weakness, ultimately securing a comparable unit only by agreeing to pay a security deposit equivalent to 3 months' rent and providing proof of income that far exceeded the standard requirement. This financial penalty was the tangible tax on my mistake, a direct and ongoing drain on our resources. The indignities multiplied with mundane regularity. Applying for a new mobile phone plan, a process I had always considered a formality, resulted in a denial for a standard post-paid contract. I was offered a prepaid plan instead, a product typically associated with transient or high-risk customers. The clerk's subtle shift in demeanor was unmistakable. A slight cooling, a more transactional efficiency. My automobile insurance provider, upon their annual review, informed me that my premiums would increase significantly. The reason cited was not my driving record, which was clean, but a financial responsibility score derived from my credit report. The insurance company's actuarial models statistically correlated my credit history with a higher risk of filing claims. I was now paying more for the privilege of driving the same car, not because of my actions on the road, but because of an algorithm's prediction. The most psychologically damaging event, however, was the withdrawal of a job offer. After a lengthy and successful interview process for a mid-level management position that involved fiduciary responsibility, I received a verbal offer contingent on a standard background check. A week later, the hiring manager called, his tone markedly different from our previous enthusiastic conversations. He stated, with evident discomfort, that the company's third-party screening service had reported adverse findings in my credit history. While he expressed personal regret, company policy for that particular role precluded moving forward. The position required a high degree of personal responsibility and sound judgment, and my credit report, in their view, brought those qualities into question. The humiliation was profound. My professional competence, my interview performance, my entire career narrative had been invalidated by a single ancient data point. I was not being judged on my ability to lead or perform, but on a 7-year-old administrative failure. It forced a fundamental and painful question. Had my identity been permanently reduced to this one line in a credit bureau's database? This series of rejections constructed an invisible prison. It bred a low-grade, persistent anxiety that permeated every application process. Filling out forms for utilities, rental agreements, or even retail financing became exercises in anticipated shame. A profound sense of powerlessness took root, the feeling of being perpetually judged by an omnipresent, unfeeling system that offered no avenue for explanation or context. Relationships were strained as I had to explain these systemic barriers to my spouse, translating abstract financial penalties into lived limitations on our shared life goals. The dream of homeownership receded into the distant future. The aspiration for entrepreneurial venture capital became a bitter joke. I was not living in poverty, but in a state of financial probation, perpetually reminded that my past had constructed a ceiling on my present. The system was not merely punishing an old debt, it was actively constraining my future potential, enforcing a form of economic quarantine that was all the more isolating for being completely invisible to the naked eye. This was the true cost: the erosion of autonomy, the constant negotiation with stigma, and the quiet, daily burden of proving you are more than your worst financial moment. Resignation was a luxury I could no longer afford. The withdrawal of the job offer was the catalytic event that transmuted frustration into a cold, strategic determination. I realized that appealing to the fairness of the system was futile. It was not built for nuance. Victory would not come through protest, but through a meticulous, almost scholarly understanding of its rules and a willingness to wage a war of attrition on multiple fronts. This was not a quick fix. It was a protracted campaign of financial and administrative rehabilitation. The first and most critical step was a complete mindset shift. I had to stop viewing myself as a victim of an unjust system and start seeing myself as a strategist navigating a complex, rule-based game. The goal was not a fleeting score increase from dubious shortcuts, but the legitimate, durable reconstruction of my credit identity. I began by acquiring my full credit reports from Equifax, Experian, and TransUnion, not just the abbreviated summaries from monitoring services, but the complete, dense documents. I studied them like legal contracts, line by line. I learned the precise language of the codes: CO for charge-off, CLS for closed by grantor, the different status codes for payments. I disputed every minor inaccuracy I could find: an outdated address, a misspelled employer name. Each correction was a small but psychologically vital victory, a reassertion of control over the narrative. Armed with this forensic understanding, I devised my primary counteroffensive. I dismissed the conventional advice of simply waiting 7 years for the charge-off to age off my report. That was a sentence, not a strategy. Instead, I focused on a targeted professional appeal to the original creditor, the goodwill letter. However, I rejected the templated, mass-mailed approach. My research became granular. I identified the CEO, the head of the Office of the President, and the Investor Relations Department of the financial institution. I understood that to bypass automated systems, my appeal needed to reach a human with the authority to exercise discretion. The letter I crafted was a concise one-page document. It adhered to a strict protocol: direct acknowledgement. It opened with a clear statement: I am writing regarding account number, which was charged off in month year. I take full responsibility for this delinquency. Concise context, not excuse. I provided exactly 2 sentences of factual context. At the time, a change in my address and my failure to update my contact information with your institution led to me missing electronic statements. This was an oversight, not an indication of financial hardship or irresponsibility. Evidence of reformation. This was the core. I highlighted my spotless payment history with them for years prior to the incident, and, more importantly, my impeccable conduct with all other creditors since. I attached a recent credit report summary, with sensitive details redacted, to visually demonstrate my overall responsible behavior, contrasting sharply with the single derogatory mark. The specific ask: I made a polite, unambiguous request. In light of my long prior history as a customer in good standing and my consistent financial conduct since, I am respectfully requesting a goodwill adjustment, that you instruct the credit bureaus to update the account status from charged off to paid as agreed, or to remove the entry entirely. Professional tone. The language was respectful, factual, and devoid of emotional pleading. It was a business proposition, arguing that the continued reporting of this single, old error was an anomalous and outdated reflection of my creditworthiness. I sent this package via certified mail to multiple high-level addresses. This was not a single Hail Mary attempt. It was a deliberate, multi-pronged outreach. Simultaneously, I began the slow foundational work of rebuilding from zero. I opened a secured credit card, depositing funds to establish a minuscule credit limit. This instrument became my laboratory for perfect payment history. I used it for a single recurring subscription and set up automatic, full balance payments from my checking account. The goal was not utility, but the generation of flawless monthly paid-as-agreed data points. I instituted a regime of what I termed credit Baringity. I automated every conceivable financial obligation. Due dates became irrelevant. Payments occurred instantly upon statement generation. I scheduled quarterly reviews of my credit reports to monitor for inaccuracies. I learned to think in terms of credit hygiene as a permanent, non-negotiable aspect of adult life, like dental care or exercise. The dramatic, single-letter victory I sought from the creditor was only one part of the equation. The other was the undramatic, plodding accumulation of perfect months, a quiet testament to reliability built one automated payment at a time. This dual strategy, the bold, targeted appeal to override the past and the grinding, disciplined construction of a new present, formed the architecture of my comeback. I was no longer reacting to the system. I was patiently, systematically, reprogramming it with better data. The breakthrough did not arrive with fanfare. It manifested as a simple, unceremonious alert from a credit monitoring service approximately 11 weeks after my strategic outreach. The subject line was generic: change detected on your Equifax report. With a sense of trepidation I had grown accustomed to, I opened it. The notification indicated that a derogatory account had been updated. Navigating to the full report, I scanned the familiar entries. And then I saw it, the account in question. The status had been changed from charged off to account closed, paid as agreed. The negative payment history associated with it had been purged. The 7-year countdown to its automatic disappearance had been rendered irrelevant by a single authoritative human decision. The relief was profound, a physical unclenching of a tension I had carried for years. This was not merely a correction, it was a pardon. The quantitative recovery, however, was a slower, more deliberate ascent. The removal of the severe derogatory mark was like removing a heavy weight from a spring. My score rebounded significantly overnight, leaping out of the poor category. Yet, the journey to exceptional credit remained. The artificially low credit limits and the high utilization ratio persisted. This required the patient, undramatic work of my credit Baringity protocol. Over the ensuing months, as my secured card reported flawless history and my overall utilization decreased with disciplined spending, I began to receive periodic notifications of credit limit increases, first on the secured card, then cautiously from other issuers. My score climbed in incremental steps, each a validation of the new, positive data stream I was consciously generating. The final victory was not a return to my previous score, but the achievement of a new peak, built on a foundation of knowledge and systemic understanding far stronger than my earlier naive assumption of stability. The paramount lesson of this ordeal extends far beyond the mechanics of FICO calculations or dispute letters. The core revelation is about agency within complex, impersonal systems. Financial literacy, in its truest sense, is not merely about budgeting or investing. It is the forensic understanding of how one's financial behavior is recorded, algorithmically interpreted, and used as a proxy for trustworthiness by unseen gatekeepers. My error was not the missed payment. That was the symptom. The error was ignorance of the system itself, a passive trust that responsible financial conduct would be passively recognized. The comeback forged in me a proactive, almost curatorial mindset. I learned to manage my credit profile with the same deliberate care one manages a professional reputation, because in the digital age, they are inextricably linked. This hard-won knowledge is the impetus for this channel, Credit Comeback Stories. Our mission here is not to provide generic financial tips, but to conduct a deeper exploration. We examine credit not as a dry economic tool, but as a narrative force, one that can dictate life outcomes, influence mental well-being, and create cycles of exclusion or opportunity. We dissect the psychology of debt and the architecture of scoring algorithms. We interview individuals who have navigated far more complex challenges than my own: foreclosure, medical debt bankruptcy, identity theft. We seek out and deconstruct the creative, often non-obvious strategies they employed to regain their financial footing and their dignity. Your story does not have to be defined by a single oversight or a period of hardship. The system may be rigid, but it is not impervious to informed, persistent, and strategic action. Subscribe to Credit Comeback Stories now. Engage with a community dedicated to transforming financial adversity into narratives of resilience and strategic victory. Hit the notification bell, because in our next comprehensive analysis, we will be deconstructing 3 commonly accepted responsible financial habits that credit scoring models may actually penalize, widespread practices most conventional advisors fail to critique. Your understanding and your comeback begin here.